In a previous tutorial, we looked at the balance sheet and the income statement. The third statement that we're interested in is the statement of cash flows. And the statement of cash flows is important because it lets us see how cash is being used, the sources and the uses of funds. And part of the reason we're interested in this is because we use an accrual accounting system. That is, that income may not actually reflect the amount of cash that's coming in. For example, if a company lands a major contract, that's recognized as income even though the cash hasn't flowed into the company. So the statement of cash flows gives us an idea of how money is coming into the company and how it's going out. In fact, many analysts really like to use the statement of cash flows because cash is something you can't lie about. Cash is either coming in or it's going out. You can legally, through different accounting conventions, change the amount of income that's reported. So some of the uses for the statement of cash flows is that we can compare the cash from operating activities to the company's net income. If the cash from operating activities is consistently greater than the net income, we say that the company has a high quality of earnings. On the other hand, if the cash reported is less than net income, then we say that this is low quality earnings. Okay, you're not as certain about this. I mean, oftentimes, and you may have read about accounting scandals or accounting shenanigans. In fact, there are people who've written books on accounting shenanigans where they talk about how companies will report income. For example, a company might sell gas grills, something they sell generally in the summer. Well, they may call up a customer and say, hey, how about if you buy a bunch of these gas grills? You don't have to take delivery. We'll keep them in our warehouse. You don't have to make a payment yet, but yet we're going to report it as income. Well, what happens if they cancel the order? So cash is much better. Cash is a better measure of how the company is doing. And in different things in corporate finance, we oftentimes need to go and figure out the cash flow in order to evaluate a project. But in the cash flow statement, there are essentially three parts. There's the part that looks at operating activities. And right now I'm looking at actually Apple's cash flow statement or statement of cash flows, and you can see the things that are in here: depreciation, adjustments to net income, changes in accounts receivable, changes in liabilities, changes in inventories. Okay, so we're seeing how cash is being used or is being provided by these activities. Okay, the second part of the statement of cash flows looks at investing activities, and these would be things like capital expenditures on plant and equipment, or the sale of capital equipment. You sell that truck, you sell a factory. The third part is based on financing activities. Dividends paid, you can see, is listed here. Sale, purchase of stock. Does the company issue more stock to raise money? Does the company buy back some of its stock? Does it issue more bonds? Does it buy back some of its bonds? So those are the activities that go on in the statement of cash flows that are of interest to us. And in a future tutorial, I'll show you how to compute things like operating cash flow by looking at the statement of cash flows as well as looking at the income statement.